So let's add Nicole to the conversation. She's sitting right next to you, of course, Nicole Webb of Wealth Enhancement Group. The other issue, welcome, I wanted to get into was the offsides nature of how the market has caught people this year. Technology has been the big winner. Up until the last couple of days, energy has been the big loser, certainly far from what people expected might be the case as we came into the year. What do we think about that?
Absolute bifurcation here. So we're seeing a lot of the returns from Q1 coming from 20 names. Again, you talk about the technology rally, where that's coming from specifically. And look, from our perspective, the technology rally, a lot of these names were unjustly beat up last year. We're not shocked by the run back up, but also we don't think that these valuations are sustainable if the Fed doesn't give what is expected, which is cuts in the second half of this year. And our expectation is not for that. We think that as long as there's wiggle room available to the Fed because of the job market, because of the structural deficiencies of labor, that they're going to continue to take on that.
So you don't think the Fed's going to cut this year at all?
We really don't. We are of the higher than expected, longer than expected. And unless there's some structural changes to the labor market, that this is going to be a holding pattern that we sit in for some time.
You do like tech, though, at least some parts of it, Amazon, Netflix, for example. So, I mean, if you think we're in an environment that's going to continue to bring rates higher, I can't imagine that the NASDAQ, even if there's not necessarily a direct correlation to that, is going to perform well in that scenario.
And from our perspective, where we sit advising clients, we have to barbell both to the value and the growth scenario. So looking at some of these names, two of which you mentioned, we are positive on the outlook for 2024, and we think the price entry point right now is positive. Look, what we are fighting through today is we are still absorbing the 40% increase to the money supply. Yes, we have this sharp downturn in M2, but those two have to even each other out yet. And we have this expectation that the Fed does take us higher as long as the jobs market allows us to. So the strength and the resilience of the consumer leaves wiggle room for profits to come down. And we do believe that we are going to be in this wide trading range through the end of this year.
Anastasia, how would you address the issue of technology, whether it still has steam to go, whether this week is a reminder that energy is not dead just yet, and that those stocks are going to be able to do well?
Well, I think the barbell approach makes sense in terms of technology and energy and also dividend stocks. What I want to say on technology, I think people are going to find themselves in chasing mode when it comes to technology. Tech has outperformed a lot, but guess what? Hedge funds are still underweight. They've been adding. Mutual funds have gone underweight, especially some of the big tech names. So, and if you look at the landscape today, you've got a huge reset in valuations. And at the same time, these big tech companies are benefiting from AI. The semiconductors are benefiting from all the secular tailwinds, and their inventory issues are in the process of getting corrected. So I think you're still going to find growth in technology at much better valuations that we've had. And again, that chase is, to me, what keeps the sector moving higher.
Let's just take Nicole today as an example of, if we got fresh concerns about the economy, that more cyclical areas of the market are the ones that, not surprisingly, are having trouble today. Industrials, energy, as we're just talking about, but materials and things like that. Do you want to stay away from those or go into those at this particular time?
At this particular time, it's $1 million question. I would say, though, that our firm's perspective is that this is an entry point on both ends of the barbell, to your point exactly, which is we have to remain agnostic to the direction that we go. And up to this point, we are believing in the transparency that the Fed is giving us, that they are managing to a 2% target, that we should be expectant of additional rate hikes in the future, that they're not done yet. And with that, we couple it with the strength and resilience we're seeing in other data pockets, and we believe that this is an opportunity for us. Again, more opportunity in 2024.